Welcome, everyone. This is David Morgan of themorganreport.com. I have Keith Weiner, the CEO of Monetary Metals, with me today. And Keith, you've been with me several times. We met years ago. In fact, as I've bragged before, I think the first time I called you, you were getting up to take the call. I think it was like 2 hours before I got off the phone, mostly from me. I just had more and more questions for you. We both think a lot along the lines of the Austrian school, and on it goes. But we had a strong visit that first time. I want to just jump right into it. Before I do that, just give a little bit of your background, your software, what you sold the company and all that, and then why you're in this field and what you do, because you give a lot of free information on your blogs, and a lot of people seem to miss those. So if you could start with that, we'll get into the questions.
I'm sorry, I missed. It was just a little bit of audio breakup. You said the first part again?
If you could just give us some of your bio background and tell us what you do for free. I know you do a blog that's fairly regularly performed.
Yeah, so I was your classic computer geek in high school. Went off to computer science school, dropped out of that because I wanted to get into the software business. Built a software company, sold that software company, which is called Diamondware, to Nortel Networks. The date was August 19, 2008. So right before everything went over the edge, right before Nortel went over the edge. That was the last acquisition they ever did. And there were several other acquisitions that were in progress at the time that I knew of. Then they immediately began spiraling into bankruptcy, which they declared in January of 2009. So through that fall, I wasn't a student of economics before that. It wasn't really that. I mean, everyone's interested in markets, but not professionally. But at that point, I had spent 14 years building a company that I just sold, was sitting in cash. And it's like, given what was going on at the time, how do I understand this? How do I make sense of this? And what do I need to do to protect myself? So I started to study markets and economics, eventually coming to gold and, Austrian ideas. As I developed that, set of ideas, I said, okay, what do I want my next venture to be? And in a normal world, it would have been another software company, obviously. But I decided I wanted to do something that would be part of the solution to the world's problems. And so clearly gold was going to be part of the solution. I love that quote from Winston Churchill where he goes, God bless the Americans. After they've tried everything else, they'll do the right thing. And I think after we've tried everything else, we're going to be trying gold again. And so I founded Monetary Metals in 2012 with this idea of, people should keep their, personal net worth calculations in gold. People should be thinking of wealth in terms of gold rather than in terms of dollars. And then ultimately that people should be able to get a yield on gold, became kind of the focus of the whole thing. So that's my background in a nutshell.
Okay, good. Thank you for that. Well, I just got finished with the Silver Symposium. We had a lot of, people there, obviously investors, a lot of companies, but we also had a lot of people on stage, and we got a very broad view of the silver market. I mean, Jeff Clark's presentation was distinctly different from Jeffrey Christian, which was distinctly different from Chen Lin and all that. I said all that background. I'm a little tired to say this. I'm going to give you the question I get, and that is, hey, silver's in backwardation, and if the price keeps falling, what the heck's going on, Keith?
Your regular readers and probably most of the silver community, and certainly my readers, would be well aware that I've not exactly been a rah cheerleader silver bull over the last decade, to say the least. And I've made more than a few enemies, on Twitter. Wall Street Silver blocked me, others, because I say things that are not politically correct if you're cheering for a silver bull market. Because I just haven't seen the indicators that there's been anything bullish and, much of anything bullish over the last decade or so, until now. And what we're having now is actual signs that as the price is selling off, the metal's becoming scarcer. Previously you might see a little bit of signs of scarcity, and as the metal keeps selling off, then eventually more metal comes to market. You get a capitulation of, holders of the actual metal, not just paper. Futures speculators, but actual metal comes to market. That's not what's going on right now. So for the first time in a long time, I want to say going back to maybe 2015 or 2017. So we look at backwardation in the near contract, as a lot of people do, right? So we define backwardation very strictly as when the co-basis is greater than zero. So co-basis is the bid on the future minus the ask on the spot. So actually, no, the other way around. Excuse me. It's the bid on spot minus the ask on the future. So if you were to sell metal and then buy a future to recover it, when that's positive, then that's an incentive to liquidate, pull silver out of the warehouse, and that occurs, and that's pretty technical. And if you want, I can go into more detail on that. That occurs pretty regularly post 2008 on the expiring contract. As it gets close to expiry, you get a lot of selling of that contract, and then people have to roll their position, so then they buy the next contract out. And during that roll process, you get a lot of noise in the near contract, and so you get a temporary backwardation, which isn't a sign that the world is normal. The world post 2008 is definitely not normal, but it's become the new normal. It's not a sign of anything in particular to see a temporary backwardation of the expiring contract, which right now, which would be the well, actually, we just switched over. I was going to say the last few weeks would be the September contract, was certainly quite backwardated. But what's now happened, so monetary metals, we calculate a rolling 6-month continuous basis and co-basis. That's now gone into backwardation as we define it, which is a stricter definition than most people do. And that's a little bit unusual. As I said, we haven't really seen anything like that going back to 2017, but it's grown in the last week to the point where I think we're now at a high point not seen since the global financial crisis, which makes it very much more interesting as you look at that and say, what is going on in the silver market? That conditions haven't been seen, like this, in 12, 13, 14 years. What is going on? And the answer is that there's been obviously a lot of selling of futures. So all the speculators are getting flushed because they have other positions they have to tend. Silver is probably their marginal speculation, whatever margin calls that people have. But there hasn't been a corresponding selling of the metal. And so we get this inversion. Now, this is not a huge amount. I want to emphasize to people, I'm not saying that the paper and physical metal market have divorced. These prices are still really close. It's a pretty sensitive instrument to measure the basis. But it's indicating quite a scarcity that hasn't been seen, in a long damn time. Now, all of this stuff is very interest rate sensitive. The other thing that's happened, newsflash, the last 3 months, 4 months has been, 5 months has been rising interest rates. So rising interest rates should normally mean the basis should be much higher, right? So a basis near zero is a function of an interest rate at zero. So the backwardation that we see now is all the more exceptional. And so if you calculate the lease rate, which is interest rate minus the forward rate, which is essentially the basis, then you see something that's like going off the charts. And so I think there is quite a scarcity, quite a shortage of silver right now. And unless more silver comes to market, unless the people that own that physical silver can be persuaded that, big losses and pain are ahead of them and you better dump now because otherwise it'll be $11 before you can blink. If they can be persuaded of that, and I say that facetiously because I don't know who could persuade them other than themselves. But if they come to believe that, then they'll dump all their silver, and this will be the classic flush. And the price will drop another $3, $4, $5 while the backwardation goes away. If that doesn't happen, then there's likely to be a slingshot to a much higher price, and a pretty violent move seems likely to occur given the setup.
Okay, well, let me back you up a little bit, going back to the latter part of the interest rate discussion, where, the basis, co-basis, backwardations, 2 or 3 cents. And then you went on to say that the other one that you outlined was off the charts. Could you explain that a bit more?
Yeah, so the lease rate as defined by the LBMA, is LIBOR minus, in this case, SIFO. So that's what, there's a lot of industrial users that lease precious metals, gold, silver, platinum, rhodium. I mean, if it's a precious metal, somebody needs to lease it for an industrial process, catalytic converters, manufacturing, whatever. In fact, that's monetary metals business, although we don't play in the same way that everyone else plays. So it's logically one should expect that the scarcer the metal, the higher the lease rate. It becomes harder to lease something that's scarce. If your city hasn't allowed developers to build new apartments and more people are fleeing, I don't know, California to move to your state, and they haven't allowed new apartments in a long damn time, then the lease rate, the rent rate on apartments goes up. Well, that's what's happened. I can pull up a little graph right now, and if you want, share this with you to share with the listeners. But let's see here. Let's pull up the 6-month lease rate. We're at, and this is so what we measure is an indicative rate. When the banks used to quote this, LBMA every day quoted a gold forward rate and a silver forward rate,
Right.
and then the lease rate. That was the actual bank saying, if you came to us today for a lease, this would be the base rate, and then we'd put a credit risk on top of that. What monetary metals is counting doesn't include any kind of profit margin, and it doesn't include any kind of credit spread. But what we see right now, the offer on the silver lease rate is over 4.5%. So I'm just going to zoom out and go to 6,000 days. So, going back to well before 2008, we are now just about matching the peak that we saw in 2008. And then the next bigger peak before that was 2006. So this is completely, if you look at this graph, completely unprecedented. Now anybody can come to our website and see this. We have all these graphs available, 60 some odd graphs available for free on our website. Or I can share this. So if you look at the right-hand side, you can see how this thing is shooting up. And this is a function of the, some degree of function of the drop in price. Although if I scroll down, where's my cursor here? You can see that. So there was this incredible dislocation with COVID, and it just messed up all the arbitrages because planes weren't flying, metal couldn't be flown around. If you were long in London and short in New York, it became impossible for a while to deliver the metal, and so markets couldn't be arbitraged. So that weird spike that drops in, as you see in 2020. And then the recovery of that, a great deal of that is just the insane logistics snafus that a lockdown created. But you can see this, this uprising trend, certainly from late 2020 through, the present. It's more than just the current price action. Obviously, it really takes off, just after the start of the year, and now we're sitting there at almost 5% at the moment. And that's, again, a sign of quite a great scarcity of silver. And I think that's likely to resolve with a much higher price. We'll see. But that would be my projection on that. Oops, sorry.
A couple of comments. One that's interesting is seeing this is that we got that type of look in, looks like 09, early. And of course, we peaked in silver in, the end of April 2011. So it was like setting it, in just that one instance going back to 2009. Do you think that there's going to be a delay, or what are your thoughts?
So, I'll quote Yogi Berra, paraphrase him, that, predictions about the future, especially ones involving timing, are hard. The basis is not a timing indicator. Right, so we're seeing a picture of great tightness in the silver market. Does that have to be resolved by tomorrow morning? Not necessarily. My gut is telling me this will be resolved pretty soon.
Me too. I'm on your side just for backup.
This has become pretty serious, and the tighter it gets, the more tension there is, and when that thing lets go, and then what happens is, of course, the backwardation resolves itself. But as people see the momentum, they start piling onto the momentum trade both stackers and buyers of futures. And then the story begins to circulate that silver is in backwardation, silver is a scarcity. Somebody might circulate an old article of mine or yours or whoever, Bob Coleman. And by the time that's circulating through the mainstream investors, the original condition that spawned all those articles is no longer true. But by that point, everybody's just running with it.
Well said.
How high it goes, I don't know. But we have a fundamental price indicator that's currently in the vicinity of $23.20 or something like that. So quite a bit higher than the market. But the last time I can recall the market price being that far away from the fundamental price was in the opposite direction. We had a market price around $22 or $23 and the fundamental price under 18, if I recall. And so I just remember looking at that and saying, when that snaps, like think of like, two pins in a rubber band. When you finally let go, the rubber band doesn't just settle at neutral, right? It's going to shoot to the opposite direction almost as far. And so I remember looking at that saying, man, if this lets go and if that happens, you'll see a 12 handle on silver. Well, I got hate mail from that one, as you can imagine. And guess what? We saw an 11 handle on silver after that. That took a while. That was months. I want to say that was 6 months or something. It wasn't instant. But boy, that was violent. So if this happens that way, and we're at 1750 on silver, let's to make the math easy, 2350 being the fundamental. So we're off by $6. You could be looking at $30 silver just in the violent snapback move to where we are right now.
Well, adding on to that, something I pay attention to, and I know you watch almost all indicators, is looking at the commercials versus the trading funds. I mean, that's a setup that also you can build a case is at a place where you want to be long silver. What are your thoughts on that, or do you follow that?
I don't follow that as closely because I think it all comes out of the basis in the end.
Right. Okay.
It's either.
Yeah.
I'm sorry.
Well, I don't want to interrupt you. Go ahead and tell me what you want, and I'll just add a little color to it.
I mean, either people are speculating or arbitraging, and if they're arbitraging, then you should see spreads coming in. If they're speculating, they're not paying attention to this spread. Obviously, they're making a directional bet. It all comes out in the wash, and then you look at the basis, saying, the spread doesn't lie. I was reading a thread on Twitter today about a guy looking at the crude oil market, which is also in backwardation right now, making a similar case and saying spreads don't lie. Well, I think he said the curve doesn't lie, but it's the same concept. He's looking at the third contract minus the second contract, saying look at how backwardated it is. It's a record. It's this, that, and we're going to see a violent snap to the upside in crude oil, according to him. But same thing. I mean, spreads are usually pretty stable. If there's that much speculation in one direction or the other, then it will pull the spread way far from its neutral point. And if that happens, then eventually something starts to move, whether it's profit taking or stop losses, as the case may be. And then once the move starts, everybody piles on and it grows, and it can extend for quite a while. Something tells me that's what's going to happen here.
Okay. Well, let's move on a little bit. I want to get into foreign exchange. So I want to point out to, most of our sophisticated listeners, especially people that follow you, probably me as well, know that, if you're pricing gold in Australian dollars or euros or whatever, the price charts look a lot different than if you're looking at them in US dollars. So we had a little bit, just a real quick brief before we started the recording. And so what I'd like you to do is just kind of outline where we are in terms of USD gold basis, and I should say basis gold price, and other exchanges. And if you have any thoughts about a leading indicator, let's say Europe goes first, gold takes off, and therefore blah, 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 blah. I'm not trying to put words in your mouth. I'm just trying to get you to follow my thinking, but I don't want to put any words in your mouth. So if you grasp all that, you probably did. Can you comment, please?
I mean, the obvious leading indicator is when is the Fed going to cry uncle? Now that gets into my whole macro view. I don't think the Fed cares about unemployment. If you lose your job, I just don't see to put it in personal terms, Jay Powell or any of the others, Neil Kashkari, Brainard, et cetera, just, crying a crocodile tear because you lost your job. I'm not believing that. I don't think they really care about consumer price index either, other than that obviously creates political pressure. There's a lot of demands, people screaming at the Fed and so on. And ultimately they're political appointees. So if they're doing something that's unpopular, Jay Powell knows that, the president may not appoint him for another term if he's doing something that goes unpopular. But I don't think they care about any of that. I think having a dual mandate suits them really well, because whatever it is they want to do at the moment, they can point to one side or the other. And those things are believed to be trade-offs in conventional mainstream economics. Employment and inflation are believed to be opposites, like a seesaw. So they could just point to whichever side of the seesaw and say, well, that's going up, we have to respond. I mean, if I were cynical, I'd say, wow, what an empowerment, what a way to rationalize giving them all this power. So I don't believe they care about that. I think what they care about is enabling the government to borrow more and spend more, borrow and spend more than it could if it just had to live on tax revenues alone. And by extension with that, the crony, the government's cronies, the big crony banks. And so what is going to make the Fed blink is as the banking system begins absorbing losses from, due to the Fed's policies. So number one, as interest rates go up, then that means asset prices go down. And since banks have a lot of assets, or have a lot of assets as collateral, the bank's balance sheets are getting damaged just simply by declines in asset prices. Then as borrowers begin defaults, which I'm sure has already happened, that's going to cause a lot more losses to the banks. And there's a point at which the Fed is going to say, okay, and they might take cover in recession. They might point to whatever, they choose to point to, but I think they have to reverse, because the whole system has been on a one-way ratchet since 1981. It only goes in one direction, which is interest rates have to fall. And you try to reverse that, and nothing works. So when they reverse, then, and this is what I said in my Gold Outlook Report 2022, that making a price call this year, so that report goes out at the end of January. So that was before Ukraine wasn't able to, I think I said Russia is cutting back on gas exports for other reasons. That was my only mention of that whole situation. But I said basically trying to call prices at this time is the toughest it's been in a decade plus that I've been doing this, because we have a completely bipolar world. If the Fed, at that time, the Fed hadn't begun hiking yet, but if the Fed is actually going to go through with their hikes, then we're down one path, which is not bullish for silver, certainly. There's a different case for gold, a little bit. And if it goes down the other path and then it just backs off and says, no, just kidding with the hikes, we're going to continue with the easing, then obviously the price is going to go up. And so they persisted with the hikes. They're now inflicting lots of damage on their crony banks. I shouldn't say inflicting. I think the damage is there. It's more like precipitating, causing it to come out and be seen on the books where nobody wants to. It's ugly. Nobody wants to see it. And so I think when they reverse, that'll obviously be kind of an all clear sign for all assets, and certainly precious metals as being, the highest quality of the assets. I mean, you want to go back to buying bonds of, zombie corporations with both hands. Yeah. Would you rather buy silver? Obviously. As far as Europe versus the US, I think the way to look at the rest of the world is all of their currencies are dollar derivatives.
Okay.
They are a proxy way to own dollars. And when the crunch really comes to it, would you rather own the proxy to the dollar, or would you rather own the actual dollar? So they have a real crisis going on there, collateral shortages, all kinds of weird creatures of the Bretton Woods system that we're still on, or I guess you call 1971 kind of Bretton Woods 2, or whatever you want to call it. There's all kinds of weird creatures of the night that come out in the system, collateral shortages being one. So these banks in Europe are flush with euro-denominated assets, and there's a shortage of dollar-denominated assets. So everybody's desperately trying to get their hands on dollars So the euro is 99 cents. The pound sterling is $1.15. I haven't looked at the yen in a few days. The last I looked, it was what, $138 to 1 or something like that, and rising. Just crazy numbers. And which basically means the same thing that's going on domestically. People have to scramble to desperately get their hands on dollars. As perverse as that sounds. So look at all they printed, but every dollar there's a debt somewhere, and now it's the debtors that are getting crushed. So they have to sell everything that isn't nailed down to raise dollars. At the same time, I think there's a lot of buying of gold to, not quite match the selling of gold. Obviously, that's why the prices come down. But there's a lot of buying, because for every person who's saying, I'm forced to sell to meet a margin call or a capital call, there's someone else who's saying, this system is insane. I want to have a little more gold to protect myself. And right now, the forced sellers are ahead of the buyers, and so you see the price go down. But I think that will also turn around, although I'm not nearly as aggressive on my gold call right now as I am on silver.
I wrote an article years ago before the 2011 run up, and it was called "With Everybody Selling, Who's Buying Gold?" Right? Just kind of repeating what you just said. Have you looked at the Fed's balance sheet and seen, they've got this toxic mortgage on there, and no one's going to make them mark to market. But do you have any thoughts on the Fed's balance sheet itself?
I think I'm in a rare minority who believes the Fed's balance sheet actually matters, and that hyperinflation occurs when the central bank, is insolvent and can't cure it. Which I don't think we're that. I don't think we're at that point now. I don't think we're really that close to that. But I think it matters. And every time that they buy toxic bonds off the banks, right? So it cleans up the bank balance sheet. Of course, is scrutinized, audited. PB, what is it? There's a special extra scrutiny audit for banks and public companies. PCB, OC, I forget what it's called. All that stuff is highly scrutinized there. So the Fed can just, sleight of hand and then tuck it up in the attic somewhere where it's not subject to scrutiny, in the same way, and then they can declare that its value is par, even if it isn't. But at some point that matters. I don't think the dollar crisis is now. Right now, it's the crisis of all the dollar derivatives. But at the end of the day, yeah, I think that shit matters. And how does the Fed get out of it? There's no way out of it. When you become insolvent, you're insolvent. And when the market decides to call you on it, every Banana Republic central bank who has attempted to declare their peso par at one per dollar, the Swiss National Bank, right, infamously in 2014 said we're gonna keep the franc down, not up. It wasn't a Banana Republic trying to hold it up. We're going to keep the franc down. All we have to do is print to infinity to keep it down. That peg violently snapped in January of 2015. The Swiss National Bank lost something like 20% of a year's GDP in a millisecond. Yeah. And they had to let it go because it's not printing, it's borrowing. They're borrowing in francs to buy euro assets. The euro wants to go down, the franc wants to go up. So their liability is going up, their asset is going down. They eventually get to the point where they're staring down the barrel of insolvency, and they cried uncle. And so, is that going to happen to a major emerging market currency right now? Very distinctly possible. What are the candidates for that? I'm sure there's a long laundry list of, weak emerging market central banks that could have a huge crisis. When that happens, is this going to be somewhat like the late 90s when you had the Asian currency crisis, and then the Fed intervenes and open up swap lines? And I suppose that'll be another interesting signal. Let's say the Fed continues to adopt a tightening posture, but if it reopens swap lines to all the places that desperately need it, that would be another sign that
money.
A violent turnaround in the precious metals markets is probably imminent.
Good. Well, we've gone a ways. I didn't ever have a time limit on my guests, but you are a deep thinker, and certainly I followed what you said. And thank you for your time. Before we close out, I want to talk a little bit more about Monterey Metals, what you do with high net worth investors that want to get a return of gold on gold, in silver on silver, how that's accomplished, and why you scrutinize every one of these contracts to the nth degree, and why it's something that people that want those type of returns might consider.
So I mentioned earlier, I founded Monterey Metals to try to help solve the world's problem, which is our currency system is failing. And we have to go back to the use of gold and silver as money, which the world rejected by degrees, going back to the 19th century, especially silver. And then gold really, they stuck the knife in gold in 1933. 1971 was kind of the last nail. So how do you get back to, you have all this gold and silver is still there. The metal didn't go away. It just doesn't circulate anymore. So how do you kind of resurrect this old monetary standard? And my economic theory says that circulation is regulated by the interest rate. If the interest rate zero, you cannot get any circulation. So think about if you had a working gold coin standard, gold and silver coin standard, if the interest rate somehow went to zero, everybody who is working for wages, who has to save for retirement, is now pulling coins out of circulation to tuck under their mattress. Mm-hmm. If there's no interest rate, then it's just all going to disappear into private hoards fairly quickly. But as a positive interest rate is an incentive for people to deposit that coin at the bank, and bring the coin back into the market where it can circulate. And so that's what we're attempting to do, is to make available interest on gold and silver. So we have two programs. One is not restricted to only high net worth investors. And that's our leasing program. And so we lease metals to businesses that need physical metal, whether it's for we're not involved in platinum and palladium and those things for catalytic converters, but gold and silver, you have manufacturers, you have jewelers, you have recyclers, you have bullion dealers. Obviously, there's refiners. There's a variety of vertical markets where they need industrial quantities of metal in order to operate their businesses. And there's always let's say, 1,000 ounces of gold in the manufacturing business at all times. And every day they're selling some, but every day they're also buying new raw materials. And there's a constant amount of, think of it as like oil in a pipeline. No matter how fast the pipeline flows, you're getting oil out the back end, but you're always containing a certain volume, which is the length of the pipe times the diameter times pi, or diameter squared times pi. Or radius squared, excuse me. It's been a long time since I took math.
Okay,
you always have a certain volume of oil contained in the pipe. And it's the same thing with the jewelry manufacturing business, for example. So we lease that metal to them. And as you point out, we scrutinize the hell out of them because we don't want anybody to lose metal, leasing to a bad actor or, something of that sort. So we haven't had any losses so far, knock on wood. No guarantees. Anybody who says that there is a return without risk, run away from that person. There's no such thing as a return without risk, but a responsible, custodian does everything they can to identify risk, mitigate risk, control risk, and disclose risk. So anyway, so we present lease opportunities to our investors. Lease rates tend to be in the neighborhood of 2 to 3% per annum. That is metal on metal. So you give me 100 ounces. At the end of the year, we give you back 103 ounces. We count that to be a pretty good deal because the alternative is paying for storage.
Yeah.
We have another program which is for accredited investors only, with much higher interest rates, and that is a lending program. So what makes a lease is the metal is always physically present. We could go on site, we could scrape all the metal, put it on a scale, and it would weigh greater than the lease amount. It is not, does not become an asset of the lessee. It is not on their balance sheet. It is not available to their creditors if they should declare bankruptcy, for example. The other program is a lending program. We call it gold bonds. And that is a credit to the borrower that is on their balance sheet. We are taking credit risk. We do everything we can to make sure that we're the senior most creditor. So if the creditors are seizing assets for the, to pay off the debts, we're the first creditor in line. We're going to scrape everything that's there. But in that case, if let's say we lend to a gold mine, they're selling the gold that we lend them in order to make payroll, buy equipment, buy diesel fuel, and all those sorts of things. So what is available to scrape isn't necessarily physical bullion. It's a whole bunch of other things that can be liquidated, maybe turned into bullion. So obviously there are risks involved in that. This is for sophisticated, accredited investors and much higher interest rates. So we have done one gold bond, last year matured, that paid a 13% interest rate to the investors. We have others that are in the works right now at even higher interest rates than that. I have to be very mindful of what I say and not be a general solicitation. The securities regulations are pretty aggressive in this area. But anyways, the point of both of these things is to use gold as and silver, we have a silver program as well, as a vehicle for finance. It's not just something that you buy, it's the Warren Buffett objection, that it's not productive, it's not procreative. You buy this lump of metal, it sits there gathering dust. It has no utility, on and on and on about this shit. And we're saying, no, Mr. Buffett, you're wrong. I mean, historically, gold always did have a utility in finance. Again, if we can restart the gold finance market, the gold bond market, then we will restart the gold standard, and people will be using gold to finance production. And it's production ultimately that enables our society to be wealthy and successful.
Right. Yeah, if I can be so bold, Keith, just to kind of go over what you said for people that are less sophisticated. Bond versus stock. When you are a owner of an equity, when you own stock, you get to share the profits of the company. But if you loan money to start the company or a bond, if you hold a bond, you are the first in line if something goes awry, and you get to liquidate whatever the assets are, which is what Keith just said. I'm just redefining it for everybody that might not have his background. So if you're a bondholder, you're in first position. So in his example, I'm just going to expand it slightly, is if the gold company can't get the gold out to make good on the bond or on the agreement, the bondholder gets to go in and get the mine, the adits, the tractors, everything but labor. So it's the best place to be as far as having security or collateral on a financial transaction. A lot of people get the misconception that when you own a stock, you own part of the company. No, you do not. When you own a bond, yes, then you can.
Right, you own everything until you're repaid. But I was going to say, maybe a more common scenario isn't that they fail to get any gold, they get some gold. Okay. So let's say we lend the company, $10 million, and that's denominated in gold. So today's gold price, what does that amount to? I'm struggling to do my math here. What is that? I don't know, 5,000, 6,000 ounces, let's say, of gold. And let's say they produce some gold, but the costs are higher, the gold production is lower than they anticipated, and so on. And they're able to basically cover the cost of payroll and diesel, and then they pay, of that 6,000 ounces of loan, they repay 4,000 ounces of it, so they still owe us 2,000 ounces, which is, $3.5 million, something like that. And then they run out of, all the drilling that they've done and all the reserves that they had proven. They kind of run to the end of that. And now it becomes much higher risk. You just continue mining, into the unknown. What do? Well, you still have this whole property, which could be 100 acres or 100 square kilometers or whatever. You own all these tractors. It's pretty likely in that scenario that if it were to go to bankruptcy, in liquidation, we'd get that $3 million back.
Covered, yeah. Oh, yeah.
It'd probably be a lot more than $3 million, but we would take the $3 million off the top plus whatever the legal fees and administrative costs are, and then the rest goes to the equity holders. But if you bought that at $1.75 a share, you might be looking at 17 cents a share is what your recovery is at the end of that. So the debt is repaid first, which means it's a much less risky thing than the equity. Obviously, the flip side is you don't, in the debt side, you have a fixed interest rate. If we say the interest rate's 13%, you're getting you're getting your 100 ounces plus the 13. It's not going to go 10x, which the equity could.
Sure.
So there's, we were putting together a deal recently. It was interesting. One of our investors tend to be interested in fixed income. That's who signs up, and because we're not an investment bank selling shares and doing rights offerings and things like that. Then if you looked at the whole deal, he's a sophisticated guy. He's a geologist who's been in the space for decades. He looked at the whole deal and he said, I think I'd rather buy the equity. He said, I think you guys are going to get the debt repaid back, but you don't have the upside. The equity has 50x upside or whatever he estimates it to have. I'd rather be on the equity side. I'm like, well, of all the ways for somebody to say no to our proposition, that's kind of a good one. He's endorsing it. He's saying, I'm happy to be in line behind you because I get bigger upside in that position. Well, okay. So different strokes for different folks. As they say, everybody has to choose their point on the risk return spectrum.
All right. Well, we're going to close there, but not a hard close. Give us your website, any of your social media, your Twitter, your LinkedIn, or whatever you actually are on fairly regularly. But I know you're very good at your blogs, and I think people should absolutely pay attention to what you think.
Our blog is published on our website, which is monetary-metals.com. On Twitter, I'm at Real Keith Weiner. On LinkedIn, I know there's probably several Keith Weiners, but I'm one of them. I don't remember the exact URL for which one, but you'll obviously, if you see a lawyer in Cincinnati and you see some gold guy, it's probably the gold guy, not the lawyer. I'm not a lawyer and I don't play a lawyer on TV. Those are my primary social media. That's our website. And
Keith, always a pleasure. You are a deep thinker, and I commend you for going back to how can we serve others by going back to something real like it once was. I liked your analogy about, I think if I heard it correctly, shot the gold market in 1900 or drew a stake through it in 1933 and buried it in 1971 or something along those lines, but I like the analogy.
Yeah, the governments have been absolutely brutal in all this, and that was the progressive era. Largely, everybody thought, more better, comrade. Let's just socialize everything. Let's just declare, free goodies for everybody, and well, we're paying for it now.
We are indeed. All right, Keith, we'll sign off. Thank you again for your time. We'll have you back.
All right, thanks so much.